For today, we're going to be talking about some jobs report numbers, some shifts in the wheat market, and then preview the June WASDE report. Hello and welcome to Brownfield's weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing well. How are you this morning, Will?
Doing pretty good. It's been an exciting weekend on my end, and I'm actually down in Ohio right now, so got to see some farm ground through the eastern part of the Corn Belt here, and it's looking pretty good from what I saw. But yeah, got engaged this weekend. So
Congratulations, Will. That's
yep.
exciting.
Thank you. Yeah, yep. So very exciting news. Ben, anything going on with you?
No, just living life. We're in the summer months, which is, it seems like it should be, a little bit more relaxing because the students aren't here, but I find myself staying pretty busy.
Yeah. And then as a side note, I'm outside today and there's a rooster way over there somewhere. So if you hear him, just know we're recording in the morning, but the rooster seems to be a little bit late. So a quick rundown on some prices here. We saw quite a bit of fluctuation, especially to the wheat side. But starting off with July corn up 8 cents at 451. December corn up 6 cents at 468. July 24 soybeans up 4 cents at 1188. November soybeans down 5 cents at 1158. So a little bit of spread action there. Soybean oil on a cents per pound basis for July down 1.48 cents at 42.66. July soybean meal on the short ton up $8.50 at $368. That 2024 July wheat crop down 65 cents at 607, and then July 25 wheat down 50 cents at 687, and that West Texas Intermediate crude oil down 389 at 77.91. So Ben, just initial thoughts.
Yeah, so right there in the middle, both that soybean meal contract to the upside, and then all of our wheat contracts seeing a pretty good sell-off. Both of those, the soybean meal rally and then the deterioration in the wheat market, result of international policy. So if you need an example of how international policies kind of impact commodity markets, right there's two examples. On the soybean meal side, just real quick, the Brazilian government did announce that they're going to start working back or reducing export credits. So these are credits that processors and merchants, or those that trade grain, receive for exporting product that has a monetary value. It's been part of the reason why Brazilian soybean and soybean products have been at a discount relative to U.S. soybeans, or we would call a premium, right? It's cheaper for buyers to buy their product than ours. That's part of the reason. And so if the government starts to roll those back, all of a sudden, processors and merchants have to increase soybean prices of Brazilian products to be able to to make money, right? And so that's one part that could potentially bring some business to the United States if it's in play for a long period of time. And then that second one there, with the Turkey announcing, or the Turkish government announcing, a ban on all wheat imports from June of this year all the way through October. As a reminder, Turkey is the 5th largest wheat importer around the world. They dominantly import Russian wheat. The way I would characterize this is all that bullish rally that we saw the last couple of weeks due to Russian drought and freeze has largely now been offset with a Turkish ban of all wheat imports. And this is very different than a tariff, because tariffs, move grain or shuffle the decks around on the ship, whereas a ban actually reduces demand for the global market for a period of time. And so this largely just, kind of gets us back to where we were a couple of weeks ago. No longer worried about shortfall in Russian wheat production. Now, basically back to ground zero.
So it really just seems like Turkey is kind of like, you know what, we're going to step out of the market for this little time span here. So, like you said, that drop in demand coming in. But Ben, we got some new numbers out on the May jobs report. We saw unemployment, tick up just a little bit, but we did see the creation of more jobs than some expected. So where are we kind of sitting when looking at the macro economy like that? What's that signaling to you when we're seeing, I guess, a picture that you could look at two different ways?
Yeah, so we had two jobs reports kind of come out pretty close to each other. We had the jobs opening and loss report. That's a measure of how many open jobs are in the economy and how many people left jobs during the month. And And that came in at 8.1 million job openings at the end of April. That was down from 8.4 job openings in March. So a little bit of tightness in, I guess, starting to see a little tightness in the jobs market, which is what the Fed would really like to see. They're targeting a number closer to 6 million jobs posting. So we've got quite a ways to go before we get there, but that's still well below, the rates we saw at the height of the pandemic. As a reminder, sometimes we think about job openings per employed worker. That's a way to kind of standardize that, if you will. So we're comparing apples to apples. For the month of April, that jobs per unemployed person was 1.24. So a way to look at that is there's more jobs open than there are employed people.
Yeah.
That was down from a height of 2 jobs for every employed person during the height of the pandemic. So moving in the right direction. I'll say here for just a second that I think what we're starting to see now is that there has been so many jobs that have been open that as the economy is starting to slow down, and we'll talk about this in the employment report here in just a second, as the economy is starting to slow down, instead of companies trying to bid for workers to fill their open jobs, they're just canceling those open job postings, right? So it's not a layoff. It's not somebody losing their job. It's losing the opportunity for a job opening, I guess is what I should say. And so some of that competitiveness is starting to work its way out of the market now.
And you see, people always talk about, well, there's so many jobs open. You see so many places hiring all the time, and so many, I guess, positions opened up on sites like Indeed or other job sites. And it's really interesting to watch some of those to where they'll come off, but then you'll see that same listing pop up a month or 2 later. So, maybe not necessarily, I don't know. It's hard to tell how many of those jobs are actually, I guess, trying to get filled versus, I don't know. Some jobs just seem to be on the market just for the sake of being on the market. You can take that however you will, but
some companies have to, right? They have enough turnover. Maybe it's entry level positions to where, the ultimate goal, I don't think anybody would be offended by me saying this, but if you have an entry level job, the ultimate goal is that employer then has some upward mobility, right, and finds a better job. And so you're hoping that they move on and that you have to fill that position again. Those types of jobs exist. I think what the JOLTS report signaled to me the end of the month was that the slack that we have is starting to tighten. We're not tight, but it's starting to tighten.
Mm-hmm.
That was counteracted by the May jobs and employment report. So this is the report that tells us how many jobs were created or, new jobs that were filled during the month of May. And that exceeded analyst expectations greatly. The expectations were 182,000 jobs and we filled 272,000 jobs. So that's the type of report that gives pause, I think, to the dovish notion of the Federal Reserve Open Market Committee sitting there seeing a very hot jobs report for the month.
Yeah. Well, Ben, those numbers came in above expectations, but we also did see that uptick in unemployment. What do you think the correlation is there, or what do you expect happen there?
Well, so our participation rate fell a little bit, and that's always a little bit concerning. It depends on the magnitude, of course, but we saw the participation rate slip. So this is the percentage of the U.S. population that is in the job market or looking for a job, and it fell just slightly. And that's kind of what allowed for that unemployment rate to tick up to 4%. I'll remind our viewers that 4% is still very tight job markets. Traditionally, we've considered 4 to 4.2 to be full employment. That's what we had traditionally thought of full employment. Of course, we've been at 4% or below for almost 3.5 consecutive years or months over that period where we've been at what we would consider full employment or even above full employment. And so it's still very tight. I do think that provided the doves on the Federal Open Market Committee, those that are looking for ways to cut interest rates, it did provide them a sign to say, hey, the job market is moving along. It's not where we want it yet, but it is moving in that direction to where unemployment's starting to tick higher. But I think to me, there was two things in this report that I thought were notable. First, not only did the jobs creation exceed expectations, but it largely came in the private sector. We've seen months like this where the jobs created have exceeded expectations, but it's been in government jobs.
Side.
Basically, the government has added jobs. This was private jobs. 229,000 of those 272 jobs were private sector jobs, compared to 43,000 jobs in the government. Okay, so that to me is a notable point there. The second thing that oh, go ahead.
I was just saying it's a positive signal. It's self-propelled.
Well, so yeah, so like I mean, I think this just signals again that the general economy continues to find ways to add jobs. It continues to be resilient. The second thing that stood out to me was when we look at the average hourly earnings. So the average hourly earnings rate increased 0.4% month over month. That was up from 0.2% the period before. That makes year over year annual hourly wage growth at 4.1%. It is hard to tame inflation when we have annual wage growth still at 4%. So I think these jobs reports, even though there was something there for both parties, the doves and the hawks on the Federal Open Market Committee, I still think that this favors, keeping interest rates higher for longer.
Yeah. Because
we haven't seen the underlying fundamentals that have led to a consideration of lower interest rates.
Yeah. And just on that, from an employee's perspective, it is difficult when you're thinking about the inflation rate being as high as it is. And, it's a chicken and egg situation where then growth in salaries are hope, from the employee standpoint, hoping to try and keep up with the best it can with inflation. But then at the same rate, that kind of spurs and feeds back into it. But Ben, just a couple minutes winding down here, I want to touch on the June WASDE, USDA's global supply and demand estimates. So the average trade estimate, it's looking for a drop in carryout for corn, a drop in maybe some trade expectations in corn, but some upticks maybe in soybeans. Walk me through your expectations as we look at USDA's next big report.
Yeah, let's stay on the old crop balance sheet here for a couple of seconds. So nothing terribly surprising in the 2023-2024 expectations. This is the crop from last year that we're still marketing right now. Couple of things, I could make the case for a reduction in wheat exports that would increase wheat carryout stocks. The current trade estimate is no change in old crop wheat numbers, but like I said, I could make a case for higher ending stocks just on lower wheat exports. Corn and soybeans, we might see some small changes in demand, but I really don't think we're going to see a whole lot. And so for me, the big area of interest on the old crop supplies is going to be in those global numbers. Again, we've largely seen some production challenges around the globe, whether it's flooding in Brazil, whether it's drought in Russia, you name it, right? Of course, those all impact new crops depending on the marketing year as well. But I think we'll see some deterioration in global stocks, global production and global stocks for the old crop. I don't think it changes the sentiment in this old crop market. We've got plentiful supplies. A lot of the bullish concerns have now worked through. That creates a bearish sentiment to the old crop market. It's not a bear market, but just a bearish sentiment as we move ahead.
Looking at the wheat side of the numbers to come out in this report, I'd almost expect the report to be too far along to fully account maybe the turkey adjustment there, or do you think that will be fully baked into the reports and the numbers?
No, it could be. I mean, like sometimes timing of this is kind of challenging. We could see some adjustments in the turkey numbers. Of course, I think we'll see the adjustments in the Russian market. Mm-hmm. So that would impact those wheat stocks numbers or those wheat numbers
just a little bit. Yeah. Maybe.
Yeah. Just those would impact those wheat numbers. Again, I'm expecting some further deterioration in South American production numbers for old crop supplies. Again, we've seen some challenges in that market, and there's been a huge discrepancy between USDA and the South American counterpart. We've seen some adjustments there, but I think we'll see it again. I think my main message is we'll see some tightening in the global production numbers and global stocks, but I don't think it's enough to change the overall sentiment in the market for old crop.
Yep. All right, Ben. Well, we're kind of running low on time here. So looking forward into this next week, what should farmers and ranchers really be paying attention to?
Yeah, it's a busy week, especially on Wednesday. So Wednesday is the second day of the Federal Reserve Open Market Committee meetings. They start Tuesday and go through Wednesday afternoon. During the middle of that meeting, we'll be getting updated consumer price index numbers. So this is a measure of inflation. The Federal Reserve will have a chance to look at that data before releasing their policy statement. Later in the afternoon is when they release not only whether they're going to change their short-term federal funds rate, but they also release the quarterly dot plot. And that'll probably actually be the bigger of the two things, because that dot plot signals their expectations of how many rate cuts for the year. As a reminder, last quarter, they were still forecasting 3 interest rate cuts this year. I think there'll be quite a bit of scrutiny of whether there's 1, 2, or none. Probably more between the expectations of 1 and 2, but that's Wednesday afternoon, could have a big impact in terms of the overall macroeconomic market and our commodities. Wednesday is also the WASDE day. We just previewed some of the WASDEs. I don't look for USDA to make many, if any, changes to new crop production numbers. The question will be on demand and then global supply. So that's that. Thursday, we get producer price index numbers. That's another measure of inflation that the Fed watches closely. We get consumer sentiment on Friday. And then next Monday, the National Oilseed Processors Association report for May. So a busy, busy week.
I know you always smile when you see that NOPA report pop up. So
that's a good report.
Yeah, viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again for your knowledge and information on the program. I'm Will Robinson on Brownfield.